and welcome back. I'm Raymond Dahlman, and this is the weekly economic update for the week of July 5th, 2021. I hope everybody had a fantastic 4th of July weekend and Independence Day. I've got all my fingers. Hope everyone out there has all of theirs. Hopefully no one wound up in the ER with some missing digits or even worse. I did see there were some deaths from fireworks. Hockey goalie with Columbus Blue Jackets got one in the chest from what I understand. So be careful out there, folks. So as far as financial news, let's go ahead and jump into the weekly update. Last week I didn't do a video on Friday. I apologize. I was being lazy. So going into a holiday weekend, wanted to spend a little me time. So, all right. Strong unemployment reports and rising consumer confidence sent the stock market up last week. Dow Jones was up 1.02. The S&P was up 1.67. The Nasdaq was up 1.94, and international lost 1.42. So it looks like domestic did fairly well. International suffered a little bit. Rising conviction in the economic recovery and waning inflation worries drove the stock prices higher. I don't know if waning inflation worries is really the right way to look at things. Some of the reports I've shared over the last few weeks and with clients, inflation is getting a little bit better, but it still hasn't improved. Amid a week-long march higher, market leadership changed hands throughout the 5 trading days. The leadership baton alternated between the technology and high-growth companies, which responded to lower bond yields, and cyclical stocks, which rallied on higher oil prices and successful bank stress tests. All right, consumer confidence is up. It's reached its highest level since the onset of the pandemic. All right, so that's kind of the general news. Let's see, this week, today we had the ISM Services Index reporting today. Tomorrow, job openings and labor turnover survey. The FOMC minutes comes out tomorrow, and then Thursday, jobless claims. Excuse me. And then Thursday, we have 2 companies reporting earnings, Helen of Troy Limited and Levi's. So, all right, a couple of white papers that are going out this week. The first one is ways to fund a special needs trust. Why would you need a special needs trust? Maybe you have an older couple who maybe they can't handle their finances anymore. Maybe you have a child or someone who has some special needs. They're not able to care for themselves, and you might set a trust up to cover those needs. There's 4 basic ways. One method is simply just a lump sum, pour assets into it from immediate family or extended family. Another is with life insurance. The third is through a settlement or lawsuit, and lastly, an inheritance. So basically, this just goes through the different kinds. If it's coming from the family route, you can start it out with a few dollars into a trust, and then add more to it later. You could have assets willed to that trust when those people pass away. Also, with a life insurance funding the trust, instead of having your husband or your spouse as the beneficiary, it would actually be the entity of the trust would be the trust for John Q. Smith would be the beneficiary of Jane Smith's life insurance policy. So those are kind of the simple ways, or the most common ways that those are funded. Next, thinking about summer travel plans. It's kind of a short white paper, some things to think about. There's been a lot of news coverage around airlines canceling flights, being short-staffed. I have friends and clients who work for the airlines, and I've been hearing that that's been a problem. High gas prices. The national average is $3.09 a gallon in June, which is quite a bit higher than a year ago at this time. Granted, we did have a massive surplus in oil and gas leading up to last summer due to the shutdowns and the lockdowns. So It is a little unfair to compare gas prices on June 1 last year versus June 1 this year. And then the Delta variant. Oh my God! The Delta variant's coming to get us. From what I've seen, just looking at the websites that track cases and deaths and all that good stuff. It does appear, specifically looking at the UK, that cases have climbed a little bit, but it does appear that the death rate still is flatlined. So, I'm not really worried about it. All right. Here's an article from Brian Westbury at First Trust. He's talking about the article's titled "Twin Deficits Won't Tank the Dollar." So interesting read, and I'll probably read a lot of this. Actually, it's very interesting. So it starts out, many analysts have been thinking and writing about the twin deficits and whether the record-breaking size of those two deficits combined mean the U.S. dollar is about to plummet versus other currencies. This is something I've been talking about. Before we get into the weeds, a little background is necessary. When we talk about the twin deficits, they are talking about the budget deficit plus the trade deficit combined. Combined, these two deficits were 22.8% of GDP in the year ending in the first quarter, easily the highest on record. Before the pandemic, the record high was 12.8, so about 10% higher, or 10 points higher. Let's see. Before the financial crisis, previous peak was 8.7 in the 2004 and 5, and 8% back in 85 and 86. So why is it called the twin deficit? It's a superficial, this word's always hard for me, Keynesian theory that suggests that they should go together. The idea is that if the United States runs larger budget deficits, it should have higher interest rates, which should drive up the value of the dollar. In turn, higher dollar means that more imports, meaning we can buy more stuff, and lower exports, for foreigners buy less because it costs them more to get dollars. This theory seemed to work in the 80s. Budget deficits grew under President Reagan, mostly because of more defense spending, and so did the trade deficit. However, the theory fell apart in the 90s when budget deficits fell and even into a surplus. If the theory held, you'd expect the trade deficit to shrink too, but that didn't occur. In fact, the current account deficit, which is the most comprehensive measure of the trade deficit, hit a new peak at 3.9% of GDP in 2000, and even higher than its peak of 3.3 from the late 80s. What this showed was that the old Keynesian theory behind the twin deficits was too superficial, and two deficits don't have to move in tandem. All right, so in the 1980s, the Reagan administration cut taxes, deregulated, and got inflation under control. All of these policies made the U.S. a better place to invest. Those policies attracted capital from the rest of the world, which pushed up the dollar and also increased the trade deficit. By the 1990s, a large combination of these factors helped the economy and reduce the budget deficit. These include lower inflation, the peace divide, and President Clinton holding to the federal spending caps inherited by President Bush, the failure of Clinton Care, enacting welfare reform, and Medicare reform. So all these things really did help. But as you can see, that while it was thought that the two would move together, they're actually disconnected in how they in fact do work. Right now, the combined twin deficit is at a record high, but notice that almost all of the increase is due to the budget deficit. The trade deficit is larger than it was a year ago, but roughly the average has been the same for about the last 20 years. So the trade deficit's still on the same trend. What is different today is that the federal government has been overspending by leaps and bounds. So let me skip down to kind of the conclusion here. Considering all this, we do not expect a massive increase in the trade deficit to match the surge in budget deficit. The lack of a massive trade deficit to match the budget deficit is important for forecasting the dollar because a massive trade deficit could put political pressure on the Federal Reserve to reduce the exchange value of the dollar by postponing rate hikes. Again, they don't see this happening. So I think basically what Brian's saying here is he doesn't expect interest rates to go up at all. while the trade deficit is something, that is a worry, it still appears to be on the same trend. What is out of its normal trend is, normal, is the, deficit spending that has been going on, really since 2000. So, all right. Next article I wanted to share was, I saw this last week, the Fed's reverse repo program sees demand soar to just under $1 trillion overnight. And what this is the banks have to keep a certain amount of cash on their balance sheets based upon all their other assets. So, it's the reserve requirement. So what they'll do is they will swap treasuries with the Federal Reserve so that they can have cash. So, and usually there's some interest that's paid, but essentially it's moving, it's a shell game essentially where they're moving money around all the different banks so that they have, so that their balance sheets line up and have the right amount of reserves at the end of the business day. So, but what has been happening here is that in earlier June, demand for the repo or reverse repo hit a high of 755.8 billion, but it climbed towards 1 trillion in the last week. Essentially, the Fed is keen to reduce cash balances in the banking system to avoid any overnight rates from going into the negative, wrote Gordon Shannon, a portfolio manager at 24 Asset Management. Repo operations soak up some of the excess liquidity currently in the overwhelming U.S. money market funds, which have been flooded with cash the last year. So it's kind of multiple problems all at the same time. So to look at this, in a visual picture of this. This is from the St. Louis Fed, and going back, I think this goes back to like 2008. You can see the volume of the reverse repo agreements through the last almost 20 years, and this last year, you can see this huge spike. Is this a major problem? I really don't know, but it is certainly outside the norm, and something to definitely pay attention to. So again, there's a lot of little problems out there that are seemingly being ignored, and one of these little problems I think someday soon will turn into a very big problem. All right, and then some little tips here at the end of today's broadcast. 5 money moves before the Fed starts raising interest rates again. This was from Friday the 2nd out of Yahoo Finance. All good advice. The first one talks about refinancing your home loan. If interest rates do start to rise, which I don't think is going to happen this year, but if it happens, it's better to get that done sooner than later. I've got some friends out there who are in the lending business, and I'm always seeing their emails of what the current rates are, and so rates are good. You're probably never going to have an opportunity like this again to get a mortgage at 2, 2.5%, 3%. So, all right. Next one: consolidating your debt. As a former debt collector who did that for 8 years, being out of debt gives you a lot. A, it's a lot less stress, and B, it gives you a lot more flexibility in your life. So, if you're up to debt in your eyeballs, and you want to quit that job that you hate and go and do pottery or painting or whatever, if you owe the man, that makes it really, really hard. Work on your credit score. Well, it kind of goes hand in hand with your debt. If you have too much debt, your credit score is going to suffer. So, like I said, paying down debt, paying your bills on time. I know it's a crazy concept, but those who pay their bills on time and have good credit, usually it's weird. They oftentimes are the same people who prepare for the future. So, all right, refinance your student loans. Again, interest rates are super low. You might as well take advantage of low interest rates, and especially if you have a large amount of student loan debt out there, you're not able to file bankruptcy on it thanks to our legislators. Again, just being smart with your money is a good idea. And then last one, ride the hot stock market. or the red hot stock market. Sorry, I misspoke. This something to be careful with. So, I mean, I do this for a living, and you know, there's oftentimes I'm surprised by some of the things that do occur. So, just because someone's in this business doesn't mean that we don't have crystal balls sitting on our desks giving us the answers for tomorrow. So, you know, I'm just looking at the data just like everybody else and making informed judgments. So. Be careful if you're investing in the market on your own. You know, do your due diligence, and hey, if you have a question, that's what I'm for. So, all right, well, that's everything that I had for today. Hope everyone has a fantastic week. It's a short week. It's a Tuesday, and looks like the market's already closed. It's 2:23 Mountain Time, and the Dow is down 208 points. So, not a great way to start off the second half of the year. I mean, granted, we're already in the second week of the second half of the year, but you know, it's really when things start to get back to normal. And I think we have one more holiday here this summer, and then we head into fall. So, but everyone out there, take care of yourselves. Get some exercise. Go do some fun stuff. You know, if you haven't taken that vacation yet, you know, start planning it and enjoy the time we have. So. Talk to everyone on Friday. I promise I will do a video. And hope everyone has a fantastic week. Bye-bye.